Over the last 12 months, the enterprise software giant HubSpot executed what you could really only call a flawless operational masterclass,
Oh, absolutely. I mean, they posted a staggering 83.8% gross margin.
which is wild. And they achieved their first full year of GAAP profitability, too, meaning they actually made real money by strict accounting standards, instead of just relying on those startup growth metrics.
Right. The days of just burning cash for growth are over for them.
Exactly. And they aggressively stole massive enterprise clients away from legacy competitors like Salesforce. By every conceivable internal business metric, I mean, they are just winning.
They really are.
So why did their stock price just collapse by 62%? Welcome to the Deep Dive. We're taking you into the epicenter of, honestly, the most profound technological shift in software history.
Yeah, it's a massive shift.
Today, we are dissecting HubSpot, ticker symbol HUBS, and exploring the brutal tug-of-war between their incredibly strong business fundamentals and the existential terrifying risks of the new AI era.
And to navigate this collision between, flawless execution and a crashing stock, we are pulling from a really dense stack of financial intelligence today.
We've got a lot to get through.
We do. We're evaluating highly detailed Wall Street analyst reports from Barclays, JP Morgan, and UBS. And we're contrasting those institutional views with insights from a prominent independent equity research blog.
Right.
Plus, we're cross-referencing all of that against HubSpot's own internal investor relations data.
And it is so wild to watch this specific scenario play out from our vantage point because HubSpot is a uniquely important company for us to cover.
It really hits close to home.
It does. Over at iMaps Capital Markets, our operations practically run on several of HubSpot's software hubs. So we are watching our own daily operating system undergo an existential crisis in real time.
We are entirely dependent on them.
We really are. Plus, for those of you tracking the IMAX investment universe, HubSpot is actively included. That means it's eligible for the underlying portfolios of those iMaps actively managed certificates, which are created by asset managers and traders directly on the iMaps platform.
So we're really looking at this from multiple angles.
Exactly. We're analyzing this company from the outside in as investors and from the inside out as heavy users. And the core tension here is just unprecedented.
Yeah.
Okay, let's unpack this. The stock has been trading recently around $225. That is down from massive highs, largely due to a market panic that analysts have dubbed the SOCalypse.
It's a spocalypse. That term captures the sheer anxiety of the moment perfectly, don't you think?
It sounds like a bad sci-fi movie, but it's real.
It really is. What we are witnessing is the incredibly difficult transition of a $30+ billion company trying to pivot from a traditional seat-based software model.
Right, where you charge a toll for every single human using the platform.
Exactly. Pivoting from that to an AI-driven, outcome-based model, the entire market is collectively holding its breath right now, totally unsure if a software company can actually survive eating its own primary revenue stream.
But before we can really understand why the market is panicking about the future, I feel like you have to look at the engine that built HubSpot's current $3.13 billion in annual revenue.
You really do. You have to understand what is actually at stake here.
Right, because they didn't start as the behemoth they are today. Back in the mid-2000s, founders Brian Halligan and Dharmesh Shah essentially invented the whole concept of inbound marketing for small and medium businesses.
Yeah, the premise was totally revolutionary at the time. Basically, stop spamming people with cold calls and instead pull them in with high-quality content.
And they captured the small business market brilliantly with that tool. But the real genius of their strategy was evolution.
Right. They took that initial wedge and expanded it into this comprehensive smart CRM platform.
Which is huge.
It's massive. Today, they serve roughly 288,000 customers globally. They provide interconnected hubs for marketing, sales, customer service, operations, commerce, you name it.
And the reason they can maintain those near 84% gross margins comes down to a really specific philosophical choice they made regarding software architecture.
The crafted, not cobbled approach.
Yes, they call it crafted, not cobbled. I find this distinction critical because it explains the stickiness of the product.
How hard it is to leave.
Exactly. Think about legacy enterprise software. It often resembles a Frankenstein monster.
Oh, totally. A massive tech conglomerate will acquire a marketing startup and then, buy a separate sales tracking company a year later, and then maybe purchase a customer service software company.
And they just stitch them all together and sell it as a suite. That is a cobbled approach.
Right, because the underlying code bases are entirely different.
The data gets tangled, the user interfaces clash, and corporate IT departments end up spending half their annual budget just trying to force the different tools to communicate with each other.
Which creates immense friction for the end user. But HubSpot took the complete opposite path.
Right.
They built their entire platform on a single unified code base, relying on one central database. It is meticulously crafted from the ground up. It's kind of like a well-planned city infrastructure compared to a chaotic, sprawling series of acquired neighborhoods.
That's a great analogy.
Yeah. So if a sales rep looks up a client's profile, they are pulling from the exact same central data pool as the marketing team running email campaigns or the support team handling a billing issue.
So there's zero technical debt.
Zero. There's no data fragmentation.
And the downstream effect of that architectural choice is that once a company adopts 3 or 4 of these interconnected hubs, HubSpot basically becomes the central nervous system for the entire organization.
Right. It becomes far too painful to rip out.
And that inherent stickiness is exactly what is fueling their biggest growth driver right now, which is their aggressive move upmarket.
Yeah, for a long time, they were viewed strictly as a tool for small businesses.
Like mom and pop shops.
Exactly. But according to the JP Morgan and UBS partner checks in our sources, they are seeing immense sustained strength in the mid-market to enterprise space.
We are talking about successfully courting companies with 200 to 2,000 employees.
And the math on those larger deals fundamentally changes the trajectory of the company. Historically, a HubSpot agency partner might celebrate closing a deal worth maybe $30,000 to $60,000.
Which is nice, but...
Right. But now the partner channels are reporting that average deal sizes in this upmarket segment are surging to the $120,000 to $130,000 range.
Wow. Double or triple the size.
Exactly. Scaling companies are hitting a breaking point with the complexity of their older, cobbled-together software, and they're triggering displacement migrations.
Meaning they're ripping out the old stuff.
Yeah, they're actively dumping legacy systems like Salesforce, Marketo, and Microsoft Dynamics, and they're consolidating their entire front office operations directly onto HubSpot.
Because over the last 5 years, HubSpot closed the customization gap, proving they can handle the heavy, complex workloads of larger enterprises.
Right.
Okay, so I am looking at this trajectory, and I see a company boasting incredible margins, pulling off successful displacement campaigns against industry titans, expanding its average deal size massively, and achieving GAAP profitability.
It looks unstoppable.
It does. By all standard business metrics, this is a picture of total dominance, which brings us to the massive disconnect. Why has the stock chart over the last 12 months looked like a roller coaster going straight down?
Well, because the stock market is essentially a forward-looking expectation machine. And over the past year, HubSpot's narrative was hijacked by 2 massive external shocks.
Okay, let's get into the shocks.
The first shock created an artificial temporary high. In the spring of 2024, rumors leaked to the financial press that Alphabet,
The parent company of Google.
right, Alphabet was in talks to acquire HubSpot for somewhere between $30 and $35 billion.
Oh, wow. So the market priced in a massive buyout premium instantly. Investors piled into the stock, assuming Alphabet would pay top dollar to just, instantly acquire a massive footprint in the CRM space to compete with Microsoft.
Exactly. The anticipation became the entire investment thesis for a large segment of retail and institutional buyers. But then, in July 2024, Alphabet walked away.
Wait, they completely walked away?
They walked. They didn't even reach the formal due diligence phase. They were likely spooked by the intense regulatory scrutiny surrounding big tech acquisitions at the time.
That makes sense given the antitrust environment.
Right. And the moment that news broke, HubSpot's stock plunged 19% in a single day. The artificial floor created by the buyout rumor completely vanished.
Okay, a 19% drop explains the removal of the buyout premium, sure. But it certainly doesn't explain a 62% total collapse.
No, it doesn't.
So that brings us to the second shock. The phenomena the market named the SaaSpocalypse.
Here we go.
Let's fast forward to February 2026. Anthropic releases a powerful new AI agent called Claude Cowork.
Yeah.
And that single product launch triggered an existential panic across the entire software sector. Within 48 hours, investors wiped out $285 billion in market value across the industry. So what does this all mean?
Well, the launch crystallized a fear that had been simmering for months. It forced investors to confront the reality of seat decay.
Seat decay.
Yes. To understand why Wall Street hit the panic button, you have to look at how software companies actually make their money. Roughly 98% of HubSpot's revenue comes from recurring subscriptions.
Okay.
Historically, the entire software as a service industry has used a toll booth model. You charge a monthly licensing fee for every single human seat.
Right. If you hire a new sales rep, you pay for a new seat.
Exactly. If you hire 50 customer support agents, you rent 50 new access licenses.
So if you are listening to this and you are running a business, you might hear about an AI agent that can do the work of 10 human customer service reps and think, this is fantastic, I can drastically cut my labor costs.
Which is the dream for a business owner.
Right. But to a software investor, that exact thought is terrifying. If a company replaces 50 human workers with 5 human supervisors managing a fleet of AI agents, 45 software seats evaporate overnight.
They just vanish.
The market realized in real time that AI is fundamentally cannibalizing the very metric, human headcount that drives the entire revenue model for companies like HubSpot. The better the software gets at doing the job, the fewer humans need to use it, and the less money the software company makes.
It is a structural threat to the economics of the entire industry because HubSpot has massive exposure to small and medium businesses.
Who are super motivated to cut costs.
Exactly. They are hyper-motivated to cut labor costs to survive. So the market priced in a worst-case scenario where HubSpot's core recurring revenue slowly bleeds out as their customers deploy AI to shrink their human staff.
But the executive team at HubSpot isn't just watching the asteroid hit and hoping for the best, right?
No, definitely not.
They are executing an incredibly aggressive pivot, effectively attempting to change the fundamental nature of software pricing before the market forces them to. Starting in mid-April 2026, they rolled out a massive strategic update to their Breeze AI platform.
This is the pivot.
Yeah. They're abandoning the toll booth model and shifting to outcome-based pricing.
This is the critical transition. They are shifting from a licensing model to what essentially functions as a commission model.
Here's where it gets really interesting. Let's break down the mechanics of that. Instead of paying a flat monthly fee for access to a support tool, or paying an arbitrary flat fee to use an AI feature, HubSpot completely changed the math.
How so?
The Breeze customer agent is now priced at 50 cents per resolved conversation.
Okay, 50 cents.
Yeah. If the AI fails to solve the customer's problem and has to route it to a human, the business doesn't pay that fee. And for the sales side, the prospecting agent shifted to $1 per lead recommended for outreach.
Wow.
They are directly aligning their revenue with the actual measurable business value they generate.
And the theory behind this pivot is brilliant. Let's say an AI agent allows a mid-market company to handle 10 times their usual customer support volume using half the human staff.
Okay.
Yes, HubSpot definitively loses the recurring revenue from those human seats, but they now capture 50 cents for every single one of those exponentially higher volume of resolved tickets. They are attempting to capture a direct percentage of the labor savings they are providing to the client.
And they are pushing the boundaries even further with a feature called Hub Code.
Oh, the vibe coding.
Yes. This is a cloud-based tool built on the concept of vibe coding. It allows completely non-technical staff, like a mid-level marketing manager, to build custom applications and workflow extensions right inside HubSpot.
Without knowing how to code.
Exactly. You literally just provide screenshots of what you want, type out some visual prompts, and the frontier AI models write the underlying code. The goal is to drastically lower the barrier to entry for customization.
It's an ambitious vision, really trying to deepen the stickiness of the platform. However, I have to ground this enthusiasm with the real-world data we are seeing from the analyst partner checks.
Oh, right. Wall Street's reality check.
Yeah. The reality of this pivot on the ground is highly bifurcated. If you look at adoption rates, the customer agent, the tool handling support tickets, is seeing robust traction.
Okay, that's good.
Partners estimate about 15 to 20% adoption among professional and enterprise clients. And this makes sense from a risk management perspective.
How so?
Well, it is relatively safe for a company to let an AI handle routine, low-stakes customer support tickets by just pulling answers from an approved existing knowledge base.
Ah, right. But the stakes are way higher on the sales side.
Exactly.
If an AI hallucinates or gives a slightly off answer on a password reset ticket, it's a minor annoyance. But if your AI prospecting agent hallucinates during an automated outreach to a massive potential enterprise client, you could lose $1 million deal and damage your brand reputation permanently.
Absolutely.
So naturally, businesses are much more hesitant to hand over frontline revenue generation to an AI, slowing down the adoption of the prospecting agent.
And the partner checks confirm exactly that hesitation. But the much larger friction point across all of these new AI tools is monetization.
Right, getting people to actually pay for it.
Exactly. Right now, to accelerate behavioral changes and drive adoption, HubSpot is giving away a massive amount of free AI credits.
Free candy. They're essentially subsidizing the usage.
Yes.
But wait, if they're giving away these AI credits for free right now, they're the ones eating the immense cloud computing costs required to run these frontier models, just to build a customer habit.
Yep.
That means their margins are going to take a significant hit before they see a dime of actual outcome-based revenue from this transition.
And that margin pressure is the exact friction the analysts at UBS are highlighting.
Yeah.
Because of those generous free tiers, almost no one is actually paying hard cash for these outcome credits yet.
Ouch.
A UBS projection modeled that even if 15% of those high-value pro and enterprise customers start actively paying for AI credits by the end of fiscal year 2026, it might only contribute an additional $30 to $35 million in total revenue.
Wait, $35 million? For a scaling startup, $35 million is life-changing money. But for HubSpot, a company generating over $3 billion annually, $35 million is roughly 1% of their total revenue.
Barely a rounding error.
It is an absolute drop in the bucket compared to the massive crater that will be left if seat decay accelerates faster than anticipated.
Because the fear of seat decay is immediate and guaranteed. The promise of outcome-based AI revenue is nascent and highly speculative.
And that profound uncertainty brings us to the financial tug-of-war happening on Wall Street right now. You have an incredibly solid bull case resting on the premise that HubSpot becomes the ultimate outcome-based AI consolidation engine for the enterprise.
Right.
On the other side, you have a terrifying bear case focused on structural obsolescence and the rapid decay of human seats. This dynamic has resulted in a rare moment where the smartest institutional minds are looking at the exact same data sets and producing wildly diverging financial models.
It really is split down the middle.
So let's look at the balance sheet baseline first. HubSpot operates with the fortress of a balance sheet. They hold $1.8 billion in cash and zero net debt. And recently, their board authorized a brand new $1.0 billion stock buyback program.
Now, the buyback is a crucial mechanism to understand, particularly in the tech sector where stock
dilution, because it impacts the stock price directly. Tech companies routinely pay their top engineers and executives in stock options, right?
Yes.
While that preserves cash, it constantly creates new shares. It's the equivalent of a company printing its own money. Every time a new share is printed and handed to an employee, it slices the company ownership pie into smaller pieces.
Diluting the value of the shares held by everyday investors.
Exactly. So by authorizing a $1 billion buyback, HubSpot is taking cash from their massive reserves, going into the open market, and vacuuming up those extra shares. They are artificially shrinking the supply of shares to protect the stock price and offset that, 17% revenue dilution caused by employee compensation.
It is a strong defensive financial maneuver. And if we connect this to the bigger picture, it highlights the broader debate happening among analysts right now. If we look at the price targets in our sources, the divergence is striking.
Who are we looking at first?
JP Morgan is maintaining a highly bullish posture. They have an overweight rating and a very aggressive $530 price target.
Wow, $530.
Yeah. Their model is heavily weighted toward a 5-year horizon. They argue the broader market is entirely missing the strength of HubSpot's move upmarket into the enterprise space. They see that displacement of legacy systems as a massive, multi-year growth engine that will ultimately eclipse the near-term noise and friction of the AI transition.
That makes sense. But then you look at Barclays, who also gives an overweight rating, but slashes the price target down to $300.
Right.
And UBS takes a decidedly more pessimistic view, lowering their target to $260.
Because the UBS model is focused on the friction of the next 6 to 12 months, they are talking to the implementation partners on the ground who are reporting that deal cycles are significantly elongating.
Taking much longer to close.
Right. Macroeconomic pressures are causing buyers to freeze. These enterprise clients aren't necessarily canceling deals, but they are terrified of locking themselves into massive, multi-year software contracts because they just don't know how AI is going to reshape their own workforce requirements next year.
That's a really good point. If I don't know how many humans I'm going to employ next year, Why would I buy a bunch of software seats for them now?
Exactly. They are optimizing their current spend and only buying the specific hubs they desperately need right now, rather than purchasing the entire comprehensive suite.
Adding to the confusion, the independent equity research blog we reviewed slapped a neutral rating on the stock with a target of $225.
Which is right around its current trading price.
Yeah. Their thesis is that HubSpot is a classic show-me story. They acknowledge the brilliance of the AI strategy, but firmly state they will refuse to pay any kind of premium multiple for the stock until the actual reported AI outcome revenue definitively outpaces the losses from human seat decay.
Which, honestly, is a highly rational defensive stance. The market is demanding mathematical proof that the pivot works before rewarding the stock.
I do have to challenge this narrative of total panic, though.
Okay, let's hear it.
I am looking at a company whose stock dropped 60%, operating under the shadow of the SaaS apocalypse, yet the underlying business mechanics are defying the fear. According to the Barclays partner checks, legacy customers are currently experiencing 15 to 20% increases in their annual contract value when it comes time to renew.
And they are actually renewing.
Yes, the crucial point is they are renewing. HubSpot is actively pushing through significant price increases in the middle of a macroeconomic slowdown and during an AI panic, yet their customers are staying. They are paying the higher premiums because the crafted nature of the product is so deeply embedded into their daily operations that they cannot afford to leave.
Yeah, that pricing power is the ultimate validation of a structural moat. They have successfully established incredibly high switching costs.
It's just too painful to leave.
Right. But the tension we've been discussing remains unresolved. Operationally, HubSpot has arguably never been stronger. But the equity story, the value of the stock itself, is currently being held hostage by a massive narrative shift. It frankly does not matter how good your CRM is or how unified your code base is. If the institutional market fundamentally believes the core unit of measurement, the human seat, is going extinct.
The ultimate takeaway here isn't just a lesson about HubSpot. If your company's revenue model is currently tied to human friction, like if you charge per head, per hour, or per manual task, AI isn't just a cool feature update. It is a structural threat to your existence.
Totally.
HubSpot realized they have to aggressively cannibalize their own legacy pricing model and invent a new paradigm before the broader market forces them into irrelevance. They are a deeply entrenched, incredibly high-quality business navigating the most turbulent waters in tech.
That's a great way to put it.
They are successfully winning enterprise market share. But the ultimate success of the stock hinges entirely on a race. It is a high-stakes sprint between the speed at which AI eliminates human software seats and the acceleration of their unproven, outcome-based AI revenue.
And as we monitor this transition, it leaves us with a fascinating, almost philosophical question about the future of enterprise technology for you to think about.
What's that?
We've spent this entire deep dive discussing how AI automates tasks for human workers. But as these platforms become increasingly autonomous, as the AI agents handle the prospecting, resolve the customer service issues, and run the complex data enrichment entirely in the background without human supervision,
Right.
will the CRM platforms of the 2030s even need a user interface designed for human eyes? Or will the software simply talk directly to other software via APIs, completely redefining what it actually means to be a software as a service company?
If the humans aren't logging in anymore, who are we even building the software for?
The next time you look at a stock chart that looks like a catastrophic failure, remember that sometimes the company isn't broken. Sometimes the fundamental way we measure the health of the entire industry is shifting right under our feet. Thank you for joining us on this deep dive. Keep asking hard questions, look past the immediate market noise, and keep exploring the evolving mechanics of AI and enterprise tech. We'll see you next time.